When it comes to investing, there are many ways and means of accessing markets and investments. Passive wealth management is where you tend to have largely static or strategic asset allocation to mainstream markets, aligned to your investment risk profile. It's a case of buying the market cheaply and gaining investment exposure simply and efficiently. With passive investing, the goal is not to beat the market, it's to replicate the market. Often this form of passive investing is called index investing. Indexes are simply an imaginary pool of securities representing the broad market being invested in. When it comes to Australian shares, a good example of an index is the ASX 200, which is simply a weighted basket of the largest 200 stocks on the Australian exchange. Other examples of indexes are the Dow Jones in the USA, the Nikkei in Japan, and the FTSE in England. Investing passively in index funds gives broad exposure to markets and a strong level of diversification. In certain markets, passive investing is a very efficient way to get exposure and has proven to be successful over the longer term. On the flip side, index investing sees investors increasingly exposed to larger and growing companies, such as Facebook, for example, as they become bigger components of the underlying index. This can be great on the way up as the business grows, but if a large company like Facebook were to crash suddenly, this can have a significant impact on the value of your investment. The alternative to passive investing is taking a more active or hands-on approach. It's about trying to beat the market and/or lower risks compared to passive investing. This can be done by managers taking a more dynamic approach to asset allocation and/or through the ability to pick those stocks that they believe provide the most attractive risk or return opportunities. Not all markets are fully efficient. Active managers believe they have research, systems, and insights that allow them to exploit these markets. Typically, this comes at a higher cost than passive investing. However, the managers are aiming to provide better investor outcomes after fees. There are many examples of highly successful active managers who have been able to deliver strong value to investors across the investment cycle. There are also a range of other potential benefits of active investing. These can include better tax outcomes, reporting, and insights. They have the flexibility to vary exposures to markets based on their views of pricing, risk, and forecast future return. Passive investing can be likened to traveling on autopilot, where active investing is where there are always hands on the wheel. Both can work and can be combined successfully. At InvestBlue, we believe that taking an active approach to portfolio construction, asset allocation, and stock selection can add value in managing both risk and return over the investment cycle. Markets do not always behave rationally, and they are not always efficient. This provides the opportunity for active management to add value.